The world of investing can appear intimidating. There's a bunch of jargon, a lot to learn, and it can be confusing. If you're like many people, you may be tempted just to give up control of all your investments to an advisor. But there is another way, a way in which you empower yourself. I'm Scott Connor, a 30-year veteran trader, and you'll learn about taking control of your investments right here on Virtual Trade. Welcome to Virtual Trade. In this episode, we'll consider the three main elements required for you to take control of your investments. We'll also examine investment returns on the Thinkorswim platform. And finally, new trader Jenny Horne and I will turn our attention to a resource on the TD Ameritrade website that will help her become a self-directed investor. Let's walk through an example of how many investors first experience the market. An investor seeks out the help of a professional money manager. She gives her hard-earned money to that investment professional whose expertise she trusts. The investor pays the financial professionals a fee and in return expects good results. However, her results aren't always what she expected. When she sees these less than stellar results, she feels unsatisfied. And as a result, she decides maybe it's time she started to manage her own investments. Now, taking control of your financial future can be a good idea, but what does it really entail? Over the course of the next few minutes, we'll help you determine if managing your own investments is a good choice for you. But keep in mind that managing your own funds isn't always an all or nothing enterprise. Many investors choose to self-manage one portion of their investments and trust professionals to manage the rest. Your goal should be to find the investment strategy that suits you. For a moment, consider a driving destination that you're trying to reach, like an investment account. You want it to reach a certain level in the future. Now, you can go about it in a couple ways. You could take a taxi or Uber, or you could drive yourself. If you're a taxi passenger, the driver does the work, and you depend on his driving skills to get you there. But as the driver, you are responsible to get through the challenges to reach the destination. Think about the driver of the taxi as the manager of your investments, and think if you decide to drive, you're in charge of those financial choices. Now, let's examine what it requires for you to take financial control of your investments.
There are three things to consider when determining your level of involvement in managing your investments: time, effort, and ability. Let's start with time. Investing takes time. However, your approach or strategy will determine how much of your time it will take. Basic investing usually begins with asset allocation. This is where you invest your money across stocks, bonds, and possibly other asset types. Then you further diversify those funds into different categories within each asset class. Asset allocation with mutual funds and ETFs usually takes less time commitment. However, asset allocation with individual stocks and bonds typically requires more time as you have more trades to manage. More advanced trading typically involves more buying and selling of stocks, which requires more time as well. If you wish to trade short-term investments like options, futures, or Forex, you will need to have a more active hand in your investments each day.
So to recap, the three primary considerations in determining your level of involvement in managing your portfolio are time, effort, and ability. Your investing approach determines how much time you want to spend each day or week. Now, more advanced trading or short-term trading typically takes more time than a passive, long-term approach. Now, let's take a closer look at key factors to consider as you take control of your investments.
Now that you know how much time you need to dedicate to your trading, let's move on to effort. If your only investment strategy is asset allocation, not a lot of effort is required other than the initial setup of the portfolio. Purchasing individual stocks requires more effort because you'll have to dedicate additional time analyzing and finding quality stocks. This could require you to forecast changes in the economy and look into a company's financial statements and analysts' expectations. Some investors live for this type of analysis and welcome the challenge, whereas other investors find it too difficult or time-consuming. Analyzing charts, also known as technical analysis, is another consideration. Beyond time and effort, the ability to create a well-allocated, diversified portfolio takes know-how, such as knowing how to find a good stock, analyze a chart, or invest in the more challenging asset classes. How and what you invest in will depend largely on your knowledge. Increasing your investment knowledge will take more time. The degree of knowledge investors hope to acquire varies also. For instance, not everyone wants to manage their own investments. Some investors just want to know enough to be able to communicate more effectively with their broker. Others are happy to have a broker manage the majority of their investments, but also like to manage a portion themselves. The more of your portfolio you decide to take on, the more time and effort you must be willing to put in. This may also mean that you'll need to increase your ability to analyze and trade.
As we wrap up, it's important to remember that taking control of your investments takes time, effort, and ability. Now, that ability is gained through acquiring knowledge. And remember, managing your investments is not an all or nothing proposition. Some investors manage just a portion of their own investments. Welcome back. It's time for Tools of the Trade, where we look at various tools within TD Ameritrade, Thinkorswim, and Mobile Trader. Now, in this segment, we're going to be exploring investment returns on the Thinkorswim platform. Now, this is a question that comes up quite a bit from long-term investors, and that is, what is an expected rate of return for the market giving historical track records? So in other words, going back and looking at how some of the major broad-based indices have behaved since inception, what would I expect as a long-term investor to sort of use as a benchmark for annual returns or annualized yearly returns on average? And this is a great question. We'll be using the S&P 500 to do just that. Now, before we jump in there, think about this. How do we go ahead and calculate those returns again? Well, number one, what kind of appreciation do we see in the stock? And secondly, dividends. So those are two things that actually factor into the calculation of that annualized return. Now, what we're going to do is start off with the S&P 500. We'll use that as our benchmark. And this is an indice, again, approximately 500 stocks, but this indice began in 1926, so it's got a pretty good track record for us to use. Now, going back to 1926 till today, if we calculate, the annual return on average has been 10%. But what's very important is if you adjust that to inflation, that really comes out to be about or approximately 7%. All right, so that gives us sort of a benchmark of what we're looking for in annualized returns. Now, there's up years and down years for sure. We'll talk more about that. But here's what's interesting take about this. Approximately 40% of those gains in the S&P 500 since 1926 have come from dividends. Right? So you might think, well, it's because stocks have gone up a lot in value. Well, they have, but almost close to half of those returns have come from the dividends themselves. Now, keep in mind, markets have up periods and down periods. We know what happened in 2008 with the housing crisis, in the year 2000 when the dot-com bubble burst. So we have periods of up and down. You'll see those in the long-term chart. So every year is not guaranteed there'll be a 7% return. This is an average number that we're looking at. All right, so let's get started on this. And what we'll do on the Thinkorswim platform is we're going to jump into the charting tab of the Thinkorswim platform. Let me go ahead and do that first. I'll click on Charts. I'm going to go ahead and hide the left side bar so we can make our charts just a little bit bigger here as we jump into this. So what we're going to do is we're going to start off with a one-year daily chart of the Dow Jones. So how do we do that? Well, very simple. We're going to put in the symbol for Dow Jones, and that is, of course, $, DJI, and if I hit enter, now we can bring up a chart. Now we're looking at right now a one-year chart of the Dow Jones Industrial Average, and we can see what that has done over the last year. Now remember, each one of these candles represents one period or one trading day. Now, what we'd like to do is find out what is the one-year percentage return on the Dow Jones. Well, as you can see, we're seeing price here, so there's really no percentage indicator. So watch what I'm going to do. I'm going to move my mouse to the upper right-hand corner of the chart, click on the price access settings. I'm going to change that access to show price as percentage. Show price as percentage. Now when I click back on the chart, we can see what that percentage move has been for this period, going back 1 year. And you can see right there, it says about 17.6%. All right, so there we go. We can see a one-year return for the Dow Jones during that time. Now, there's another interesting takeaway about this. The Dow Jones is approximately 30 stocks. Does that mean that every stock in the Dow Jones is moving up 17%? No. This is an average of that entire group of stocks or basket of stocks. For example, let's do this. Let's change it from Dow Jones to GE, General Electric. Now this is what was one of the components of the Dow Jones Industrial Average. In June of 2018, it was actually taken out. But let's look at GE during that same period that we know that the Dow Jones was up 17%. Let's take a look at what happened to GE, for example. Well, you can see, obviously, you can see a downtrend here, but that stock was down 48% during that time. All right? So this is a very important takeaway here, is knowing that just because we're looking at one sector, there could be many stocks. Now, we'll look at the S&P 500. That's almost 500 stocks, or plus or minus. So you can see there are stocks up and down. All right, so very important. Also, consider that when you're looking at this long-term return on an indice, something like the Dow Jones, we're looking at stocks. If you have a portfolio that has, well, let's say stocks and bonds, that rate of return can be a little bit different. Remember, we're focusing mainly in on stocks or broad-based stock indices. Now, let's do something else. How can we make some other comparisons and maybe look at stocks and kind of get an idea of the importance of dividends and see how those stocks behaved percentage-wise with that? So here's what we're going to do. Let's go ahead and put in Johnson & Johnson, JNJ, hit enter. And what we're going to do now is start on a longer-term chart. So we do that by going to the D, right, or the time frame. We're going to drop down, click on time frame. We'll leave it as right now as daily. We want to change our interval to 10 years. So we're going to move out to 10 years. And instead of looking at one day, let's just aggregate this and look at by weeks at a time. So we'll look at 10 years, and each bar will represent 1 week. Now, let's hit OK on that and take a quick look. What are the percentage returns for Johnson & Johnson over the last 10 years? You can see, look at this number right up here, about 90%, 90, 91%. We'll round that. So that gives us an idea of the return for this stock. Let's also notice where the stock price was about 10 years ago. And we can see, well, actually, let's do this. I want to also change this back from percentage to actual number, and then what I'm going to do is go back and see what the price was. So we know it was up about 91%, and let's uncheck percentage, and let's just get an idea of where the stock was as well. So uncheck this. Now we can look at a stock price a year ago, and let's just say right around $68. All right, so we know up 90%, $68. Now, what I'd like to see in that same period is, what if we didn't look at the dividends? Now, what do I mean by that? Well, look, I'm going to follow me along here. I'm going to click on the little button here. That's the icon for chart settings. Now, when I go to chart settings, and since we're looking at a stock or an equity, I'm going to click on that bar and take a look at what we're doing. It says adjust for dividends, right? So there's different things that we're looking at. It can be none, it can be all. We were on none, but I'm going to change this to all. So now I'm going to adjust for all the dividends that have been paid out during this time. For Johnson & Johnson. Now I'm going to hit apply and OK. And now let's go let it calculate that. And now let's go back and look at those same numbers again. Now remember, we looked back 10 years ago with dividends and we saw the price was about, what, 68 or so? Now take a look. Now it's about 45. So that's quite a bit of difference between the stock price. So what we're doing is we're looking at the difference between the stock's returns in appreciation or the stock's returns with appreciation and dividends. And when you take those dividends out, you can see there's a significant difference in the stock price without counting those dividends, from 65, like we said, all the way down to 44 or 45. What I'd also like to see now is, what about the percentage return? Let's go back up to that same icon and change this to show price as percentage. All right, click on this, and now we'll look at that percentage, about 192%. Remember, without dividends, it was 90%. So Johnson & Johnson, again, a case that really points out to us the importance of dividends over the long run. Okay, well, that wraps up our segment on looking at annualized returns, what we kind of expect, and the importance of dividends in the long run. So don't forget, for more information on these tools and other great education, visit the Education Center on tdameritrade.com. Welcome back to Virtual Trade. I'm joined by a new trader, Jenny Horne. Jenny, welcome back to the show.
Thanks for having me again, Scott.
All right, well, let's get started. We're going to look at something a little different this time. We're going to look at some resources that are available on the TD Ameritrade website that can sort of help you supplement your knowledge and what you've learned so far about portfolio management, but maybe even take it to the next level.
Sounds good. As I am a beginning trader, this is something that I need to work on, taking everything to the next level, kind of.
Well, fantastic, because there are a lot of different resources available, and we're going to just delve into a few of those. We're not going to cover everything, but we'll look at some things I think everybody could find very interesting. And the nice part about this is, obviously, these are things you're going to be able to follow on your own time and when it's convenient.
That's great. That's really important to me.
Okay, well, let's get started. Jenny, what we're going to do is go to the tdameritrade.com website to start.
Okay.
And this is where we're going to find most of the information that we're going to look into this time. And you can see right now we're on that website under My Account. So Jenny, we're going to go over to Education. There we go, the Education tab. And it's within this tab that we're going to find some of the resources available today. So Jenny, if we just drop down into that tab and go over to the left side, and we'll start off by clicking on Portfolio Management and Retirement.
Great.
That's a broad category that covers a lot of things that really correspond or really complement what we've been talking about so far here on Virtual Trade.
Right. Portfolio management is kind of our whole overlying topic, I would say.
Pretty much everything we've done is focused on building your portfolio and getting it to where we want, allocation, and everything else that goes along with that. Now, Jenny, let's scroll down just a little bit here. And once we're on this tab, and you can see all portfolio management, retirement education. So there's quite a bit of education available on the different courses that are here. Let's just start by a general filter here and look at what's called courses. You can see there's videos, there are playlists, and of course there are complete courses that you can follow.
Wow.
So we're going to start off with a course that focuses on portfolio management. So we'll just click on that one, and that will get us started. Now, if you scroll down just a little bit, you can see a little bit about the portfolio management course. And let's just go ahead and click on that word portfolio management, and that will take us into the actual coursework that we'll be able to follow. Now, what you see in here is, what's nice about this is it keeps track of where you are along the course.
Right.
You can see up here that it says on progress, there's just a little bit of green. Well, that's because I actually entered this just before we opened the software and got us started. And you can see that it's giving me just a little bit of progress. Now, if we drop down below, one of the first things that we can look at is, let's click on the first one that says Introducing Portfolio Management. And by doing that, you can see there's some subcategories in here that we can look at as well. So you can see there's different things here: managing basics, building investment plans. Let's go to the fourth one that says Portfolio Management Styles. Let's go to that one first and click on that one.
I feel like I'm taking an online class again.
It is somewhat like that.
Right.
Yeah, absolutely. And as a matter of fact, we've talked a little bit about these portfolio management styles. And I'm sure you recall that we talked a lot about passive investing and more active investing, right?
Right.
And what would you say so far is our portfolio?
Well, I think we've been active, but I think that with a longer term portfolio, we're not constantly trading in the watch list, so it's becoming more passive now.
Right. We're kind of looking at a longer term management style, or portfolio, if we will. Now, I'm going to go ahead and scroll down just a little bit, and you can see that it does a great job of describing the difference between passive and active management styles. And what we can do is we can break this down just a little bit more to give you some ideas. Again, we're not going to go through the whole course here. We're just featuring a little bit of, how the course starts and the different information that you can see right there. All right, well, let's start off with passive. For example, you can see here, what are some of the things that are involved with someone who has a more passive style? Jenny, you can see a couple things. Well, it's more buy and hold, right? We're talking about a longer term portfolio. Does that make sense?
Yeah, and I like that when they say hands off, because that's kind of how I tend to think of passive, at least, which kind of applies here, it looks like.
Well, let's think of a couple other things. If you're hands off, or at least maybe like in your case, the portfolio is a longer term investment that you might hold all the way through retirement, there will be less trading, so there's going to be less time involved and perhaps less costs and less commissions. Does that make sense too?
Yes, that sounds pretty good.
Sure, that goes along with passive. And again, we're not trading as frequently either, right? So again, we're typically finding stocks that meet requirements, that we hold for a while. Yes, at some point we might decide to trade that stock in for another stock or rebalance a portfolio.
Right. Not to say it's lower importance, but it just sounds like a lower maintenance way of trading.
Right, and that's absolutely true. All right, well, let's contrast that too, and we'll scroll down, because I think they do a pretty good job here is also talking about active portfolio management. Now, some of the things we're doing in your portfolio are a little more active. like our shorter term trade in Twitter, for example.
Right.
But what would be, if we did more active portfolio management, what would be involved there? Well, it's going to be a little bit of the opposite, right? We're going to probably use more market analysis, more technical analysis as well to help time those particular trades. Does that make sense so far?
It does, and I'm sure on the opposite, we have more fees and higher costs associated with active trading.
Exactly, and of course that's going to be a little more time consuming, and it's also going to require that obviously we raise our level of education and experience as well.
Right.
Right, and again, that's what we're doing here on a daily basis.
Exactly.
And that's what you're doing on a daily basis too. And as we do that, you do become more confident. I think what's important is you not only gain the advantage of maybe being more hands-on, but you're experiencing how the stock market behaves and how your portfolio behaves in different market conditions.
Right, okay.
And Jenny, maybe you might not notice it, but you're gaining experience every time that happens.
I hope so. So what's kind of the benefit of being an active portfolio manager versus passive? Like passive is for a longer term investment, I'm assuming, but what are some advantages? Well,
typically active portfolio managers have a goal in mind. They'd like to beat the major indices like the S&P 500.
Okay.
And they figure, passively, if I were to purchase, let's say, a fund, a mutual fund or an exchange traded fund based on the S&P 500, there wouldn't be much management there because, again, it's just going to be the stocks in the S&P 500, and that's what I'd be invested in those funds. But if an active manager, even in a long-term portfolio, they'll actually do picking individual stocks within that group. So they might take certain stocks out, put certain stocks in that they like, they've done analysis on, and they feel might outperform the market in general. Does that always play out? No, it doesn't always play out.
Right.
So again, that's what obviously they're trying to do. The ultimate goal is to beat the market. In general, that would be just a passive investment in something like the S&P 500.
Right, that makes a lot of sense.
Okay, now let's do this. Let's go back to the top, all right? And let's see if we can scroll back up to the top. And then we can go back to the course dashboard. Now when you click on that, that gets you back to where we were before. So far, so good? All right, so now we want to take a look at one of the other groups in that group. Let's see if we can find it. It says allocating a portfolio. That's where we're going to go next.
Great.
All right, did you find that one?
Yes.
All right, now within allocating that portfolio, let's do this based on life stage, and I believe that's number 4 as well. Yeah, you can see that right there. All right, now why are we doing into this? Well, you can scroll down just a little bit. I think there's again, you'll see lots of nice graphics along with the course itself.
Yeah.
And Jenny, you'll also notice that during the course, you'll be taking small quizzes, right? So they kind of test you as you go to make sure that you're absorbing a lot of the different materials. But for example, this is pretty important. They focus here a little bit on risk tolerance and life stages. So in other words, Jenny, when we first started, we said, okay, you're young, you've got a lot of time before retirement, for example.
Hopefully.
So that's going to affect the way you build your portfolio. Take a look at right here underneath someone who's a young professional like yourself. What does it say about risk tolerance?
It says it's high, the highest actually.
It is high, right? And why do you suppose that is? Any ideas?
Well, I would assume it's probably because I'm not established yet, and I don't have the growth in my savings account and my portfolio, things like that.
Well, that's true. And guess what? And probably one of the most critical things in determining that is you have a higher risk tolerance because you have much more time.
Oh, okay. That's a really optimistic way to look at it.
Exactly, and that's what's really important about it. And because think about it. Let's look at the two examples. Let's take someone who's in the retirement phase. They have a lower tolerance to risk. In other words, let's say they're very close to a point where they're going to be needing the money in their portfolio very quickly, just for day-to-day activity and day-to-day budgets, right? So they can't really afford to risk a lot of that money in something like the stock market, because we've seen that stock market can make big moves. Oftentimes it comes back, right? But again, if you're going into retirement, and it was something like 2008, that might not work out too well if the majority of your portfolio was in stocks.
Okay, so time might actually be in my favor here a little bit.
Exactly. So between now and your retirement, Jenny, you're going to be able to ride several moves in the stock market, and hopefully in the long run, the market does move higher.
Hopefully.
Does that make sense?
It does.
Okay,
it does.
So again, that risk tolerance is very important, and portfolios will change. The complex, or the way that the portfolio is built is going to change a little bit. And of course, a lot depends on how close you are to retirement, what your risk tolerance is and a few other factors.
Great. Yeah, this scared me a little bit, but when you put it like that, it doesn't sound so bad.
Okay. Well, again, this is just a sneak peek, if you will, at the courses that are available on the TD Ameritrade website. And I think we put up a screenshot just a little bit earlier about the different courses. This is one that I think is very applicable to what we're talking about right now. So if you're getting started, a great point.
Yeah, this is awesome.
Okay, so Jenny, you like the courses so far?
I do, and I kind of want to explore more now that I've seen there's so many I can take.
Fantastic, and I think that would be a great route to take. Well, thanks, Jenny. That was a lot of fun, and I look forward to our next session.
Thanks, Scott. Me too.
In this episode, we explored the 3 key elements required for you to take control of your investments. We also examined investment returns on the Thinkorswim platform. And Jenny and I checked out the education section of the TD Ameritrade website to assist her in becoming a self-directed investor. I'm Scott Connor, and thanks for watching Virtual Trade.